been called the golden rule, the one free lunch in investing. And it's a lesson that screams from every page of market history. Diversify.
There's a rule in real estate that the three most important things are location, location, location. Well, my rule in investments, the three most important things are diversify, diversify, diversify.
The future is uncertain, and the one tool we have against that is diversification. And so it's about having a sensibly balanced portfolio. It's about spreading your risks in the equity markets, through developed markets and emerging markets, and through value and small cap stocks, and simply owning as diverse a portfolio as you possibly can.
Anybody that potentially just goes into one particular investment, one particular fund, because it's based on past returns or investing in a certain asset class, they will catch a cold.
These are the average returns that different asset classes have produced since 1900. But they are just average returns. Over the long term, equities deliver a much higher return than any other type of asset. But often, in any one year, shares produce negative returns. The good news is that when equities go down in price, bonds usually go up, and vice versa, which is why spreading your risk between asset classes makes sense. Diversifying within asset classes is also advisable. After the revolution of 1917, for example, investors exposed entirely to Russian equities lost everything.
We all know about the prolonged difficulty that Japanese investors have experienced since the end of the 1980s. But only historians would look towards Japan and say they were the lucky ones, because they would be able to look at what happened in Russia or what happened in China during the 1940s, when investors didn't lose a large proportion of their wealth, but all of their wealth. The message, I think, for investors who are free to invest globally is that not only can companies lose all or much of their value, but sometimes even complete markets can do that. And so spreading your money across different geographies, different asset classes, different types of securities, that reduces the extremes that you might suffer.
The economy is much more globalised now, and markets in different regions are more closely correlated than ever before. But as the 2008 crash showed, there's always at least one region that fares much better than the rest.
There's always a new market which is growing. So, for example, at the moment, Africa is being talked about as an emerging market, frontier markets. You have to rebalance, to be with the new market as it changes shape. There's no point staying in the old shape of market when things are happening globally which you need to belong to.
There are those who say that now is the time to turn away from traditional markets like Europe and the United States and to invest entirely in emerging markets such as Brazil, Russia, India, China and, yes, Africa. But that, market history teaches us, would be a mistake.
If you went back to the 1880s, late 19th century, the leading economic power was the UK, and sort of the emerging market, the China of that period, if you will, was the United States. And most people would say, you get to the 20th century, the United States economic growth was greater than that of the UK, greater than that of Europe in general. And if you were to ask somebody about equity returns, most people would say the US equity market outperformed the UK equity market because of that more rapid growth. And actually, it's not true. The UK and the US had almost identical equity returns for the 20th century. And the reason for that is British companies became much more global in their approach and actually took advantage of the faster growth that was occurring in the United States and other parts of the world.
As well as diversifying geographically, equity investors should also spread their investments between different sectors.
The so-called dot-com crash revealed the very unhealthy overexposure that many investors had to large growth stocks in particular, often in just a handful of industries like telecommunications. Those kinds of stocks suffered dramatically. Roughly speaking, in that downturn, a Russell 1000 growth index strategy was down about 55% or so. Whereas during that same period, value type stocks or small value stocks had positive returns, 5 or 10%.
So don't be a fashion victim. Remember, it's often the less fashionable sectors that provide the greatest returns. We've now looked at 5 key lessons to learn from market history. There's just one more left, and in many ways, it's the most important lesson of all. What is it? Find out in part 7.